Welcome back to the watch list. Bank earnings are coming in full swing. We started on Friday. More to come. Ken Leon's with us, Global Director, Industry and Equity Research at CFRA. Stephen Biggar is with us, Director of Financial Services Research at Argus Research. Thank you both for being with us. For the most part, we're seeing a lot of beats. Net interest income has been pretty good. I mean, we'll put Wells Fargo aside there, a little bit of a squeeze. But Ken, I'll start with you. What are the takeaways? I know each one has its own story. Is there a broad takeaway, and is there a standout story in one of these companies?
So the market today is really focused on moving away from just bank fundamentals to what's going on with the capital markets. Goldman Sachs reported today, and this divergence suggests that there's more upside opportunity as it relates to underwriting, advisory, and asset management. This is true with Goldman Sachs. It's reason why, and we have a buy in that stock, raised our target to 540. But in sentiment, mid-cap stocks such as Lazard, Jefferies, and Evercore, we have buys on all those, have done well. Kind of the rear mirror view of the banks is that with rates now expected to come down, there's a narrowing in terms of net interest margins, spreads, and net interest income. I'm not too worried. CFRA, we do every quarter, every bank on delinquencies and provisions for loan losses. We're not too concerned. The U.S. economy is still strong.
Right. It sounds like you're definitely on board. I mean, we heard a few things. Goldman Sachs, to your point, a lot of underwriting, advisory activity happening in the capital markets helps these banks. And that pretty much goes across the board. Even Wells Fargo was doing more deals and things like that, which helped them. Not necessarily what we always used to think of Wells Fargo in the olden days. But I saw JP Morgan, revenue top, strong investment banking, authorized a new share repurchase program. Goldman Sachs beat because of fixed income trading. These were just some headlines. But Citigroup topping expectations for profit and revenue, really strong results. So what do you think, Stephen? Was there one story within the banking stories that set the tone for you or surprised you?
Well, hi, Nicole. Yeah, certainly the investment banking broadly is just having a terrific resurgence after 2 down years. So revenues look very promising here. And between 20 and 70%, it's a pretty wide range, but all of them experiencing that. JP Morgan was up 46, Citigroup up 72, Goldman even up 21. So we're just seeing that widening of capital markets activity. It's just a good environment, a much better environment for capital formation here. Equity underwriting is stronger amid more greater IPO activity, and we feel there's a fair amount of pent-up demand there that will allow that to continue. You mentioned the debt underwriting strength. That's as credit spreads have narrowed, so that's also a good backdrop. And even M&A advisory deal flow has been much stronger here, as I think that's greater confidence in the soft landing scenario and the potential for lower interest rates. So they all have their own story to tell. Some are coming off better or worse comparisons versus last year, and I think that's why you're seeing the big divergence here. Some may have been on some of the larger deals than others, but it's really a good backdrop across the board.
Are we worried about something changing? I mean, because it sounds like so much positivity around this group overall. Ken, tomorrow we'll hear from Bank of America, Morgan Stanley, PNC also in the lineup this week. Are we worried things could change? Or because I see a lot of buy ratings. Those are good for 6 months, 12 months?
Yeah, I think with Bank of America and PNC, it's, of course, is the checklist as it relates to bank metrics, particularly related to the consumer, whether there's any additional reserve build, and also focus on credit card. But overall, Bank of America stock, and it's one of the few we have a hold, has run up significantly. So they need to deliver strong results. The worry list really, we went through the Dodd-Frank stress test, and all the banks generally have come through that well, and we've seen each of the banks have dividend increases. Goldman just got kind of nipped because of the black swan event, and if there's anything potentially in trading, given what happened with Credit Suisse. And then looking ahead, I think significant for investors is that the notion of the Basel III endgame being dead or being modified significantly, that there wouldn't be the narrative that we had earlier this year of a 15 to 20% increase in reserves and thereby reduce return of capital. So I think we're in a pretty good position. Financials, and I think Steve would agree, they've done well to the S&P 500. Banks, the large banks, many are still trading at half the value of the S&P 500, but they're getting rich on priced in that tangible book value.
Thank you for that, Ken. Stephen, what do you think about the rate cuts? I mean, there are folks out there, Jim Bianco Research said there should be 0 cuts. Others that are now really banking on a September cut. Where do you think that stands on what we'll get with cuts, and how will that fare for the banking industry?
Well, our house view is that we'll have 2 cuts by the end of the year, September and December. And banks are going to be sensitive to this, clearly. You know, I would say that the high rates have kind of worn out their welcome at this point. Traditionally, this is of course, a very interest rate sensitive group, and high rates can be beneficial, but not to the point where they've impacted loan growth to the extent that they have. We're getting very sluggish loan growth here in the low single digits. We're still getting some net interest margin pressure from the higher deposit costs, and you know, banks talked in the first quarter about the second quarter being a trough in net interest income as deposit pricing stabilizes and they get a little bit better pricing on their securities portfolios. But you know, that may not be the case. So we'll find out when the regionals start reporting tomorrow with PNC Financial as the first major regional to come out, and we'll see if that, you know, if the guidance and the narrative about that second half is still accurate. But so I'm less worried about the diversified banks. They're up 18% year to year, or year to date rather, and regional banks up only 10%. And I think that is encompassing that risk scenario for them.
Thank you so much. Stephen Biggar of Argus, Kenneth Leon, CFRA. Great to see you both. Appreciate it.